Europe is done with China, and this massive shift is costing Beijing nearly $1 trillion.
EU plans to increase tariffs on Chinese electric vehicles.
Too often our companies are excluded from foreign markets or are victims of predatory practices. We have not forgotten China's unfair trade practices.
China has slammed the European Commission's decision to investigate its electric vehicle subsidies.
When US tariffs crushed China's markets, Beijing ran to Europe, expecting open arms and big deals. For a hot minute, it looked really good, with fancy summits happening and bold promises being made. But the honeymoon's over. Recently, the EU has started to pull back. It is slashing Chinese exports, digging into Beijing's shady trade practices, and blacklisting China-linked firms. This major shift is leaving China cut off from one of the world's biggest markets. The CCP bet on Europe as its lifeline, but it's getting a brutal reality check. So what sparked Europe's rebellion, and what does this mean for the world's economic future? Let's unpack the chaos. Right now, things are looking rough for China in Europe. Let's start by discussing the most recent openly hostile acts that shows the mood Europe is in. In June of 2025, Europe landed a massive blow by blocking Chinese companies from grabbing medical device contracts in the EU. Why? Well, China's been caught cheating, favoring its own firms in shady deals, and Europe's done letting it slide. But this is bigger than just hospital equipment. The EU is also fighting back with hefty tariffs on Chinese tinplate, tires, and heavy machinery. All of this is to stop China's flood of cheap goods from crushing local businesses. Europe is so serious that it is even planning to slap taxes on dirt cheap imports from sites like Temu and Shein, aiming to choke China's e-commerce stranglehold. Europe calls it de-risking, but it's really about breaking free from China's economic claws. Beijing's thrown a fit, hitting back with weak investigations into Europe's pork and dairy, but it's clear that Xi Jinping is just panicking. The fight is not just about trade. Europe's slamming the doors on China's tech tricks, with Germany booting Huawei from its 5G network fears over Chinese spying. The EU's poking around Chinese electric cars and wind turbines, worried they're rigged to steal data. They're also racing to ditch China's grip on critical materials like lithium, which China hoards like a greedy giant. We'll discuss this further later in the video. Europe's calling out China's human rights disasters too, hitting officials with sanctions for abuses in Xinjiang. As if the message was not clear enough, the EU is boosting ties with Taiwan. They have begun to send warships to patrol the South China Sea, moves that drive Beijing super crazy. With Germany's new government, sworn in this June, ready to crank up the pressure, Europe is standing tall. China's desperation for Europe's markets isn't just ambition, it's, well, survival. With the US slapping huge tariffs on Chinese goods like 125% on electronics, Beijing's exports to America tanked heavily in early 2025. That's billions in losses for a country whose factories need to keep humming to employ millions. Europe, with its almost trillion-dollar market, looked like the perfect lifeline to replace those lost sales. China thought it could charm the EU with cheap products and big projects, keeping its economy afloat. But that plan's crumbling, and Beijing's learning the hard way that Europe won't be its backup. Instead of rolling out the red carpet, the EU is fighting back, and China is left scrambling to save face. But the big question is, how did we get here exactly? To really get why Europe is pulling away, we need to look at what happened a few years ago. The reactions might be recent, but this all started back in 2018, when China ran into trouble with the United States. And yes, this was when President Trump first took office. The US under President Trump started hitting Chinese goods with tariffs. This made it harder for China to sell things like steel and electronics in America. China's economy depends a lot on exports, so this was a huge hit. With the US market getting tougher, China needs a new place to send its products and keep its factories running. That's when it turned to Europe. Europe seems like the perfect partner. The EU is one of the richest markets in the world, with people who buy everything from cars to clothes to high-tech gadgets. China saw a chance to step in and fill the gap left by its troubles with the US. So Beijing started working hard to win Europe over. It wasn't just about selling more stuff. It was about building a deeper relationship that could keep China's economy strong for years to come. At first, Europe was open to the idea. China and the EU started talking about ways to trade more easily. They held big meetings where leaders from both sides sat down and made plans. These weren't just photo ops, they were serious discussions about money and cooperation. One of China's big ideas is the Belt and Road Initiative, a plan to build things like roads, ports, and railways all over the world to make trade easier. Europe was a key part of this. Chinese companies poured money into European projects, like upgrading ports in Greece so it could handle more ships. They also started working on train lines in places like Serbia, which would connect Europe to Asia and make it faster to move goods. These projects got a lot of attention. In Greece, the port deal meant more jobs and busier docks, which was a win for a country that had been struggling economically. In other parts of Europe, leaders saw Chinese investment as a way to boost their own economies. Germany, which makes a ton of cars and machinery, was especially interested. German companies like BMW and Mercedes were already selling millions of vehicles in China. They really wanted to keep that market growing. Overall, from their view, if China were willing to invest in Europe, it could mean more factories, more jobs, and more sales for European businesses. France was on board, but for different reasons. French companies make things like wine, perfume, and designer clothes, stuff that China's growing middle class was starting to buy. The idea of a closer relationship with China meant French brands could sell even more. There was even a big plan called the Comprehensive Agreement on Investment. This was supposed to make it easier for European companies to do business in China and for Chinese companies to invest in Europe. Both sides spent years negotiating it, and for a while it looked like a done deal. The mood was optimistic, and it seemed like China and Europe were building something that could last. But even as these deals were coming together, there were signs of trouble. You see, China wasn't just sending money to Europe, it was sending a flood of goods. By 2023, Chinese products were everywhere in Europe, from cheap electronics to electric cars. Since then, it's only gotten worse. Now, in 2025, amidst the US-China trade war, Chinese exports have been directed to Europe, and they have saturated the markets. This flood has come at the expense of local markets, who, as you might imagine, are being kicked out of business. It hasn't been a slow trickle. It's been a massive wave that started to worry people. This flooding of the market has occurred across all industries, including the automotive industry. Let's talk about electric cars for a second. Chinese companies like BYD and Geely have taken over Europe, which is almost scary. When they entered the market, they began selling electric cars at prices that were hard to beat for European manufacturers. A BYD electric SUV, for example, could cost 20% less than a similar car from Volkswagen or Tesla. How could they do that? The Chinese government was giving these companies huge subsidies. For European shoppers, this was great. Who doesn't want a cheaper car? But for European car makers, this is a disaster. In April of 2025, Chinese automakers held 8.9% of Europe's EV market. Just so you understand how crazy large this is, it is almost larger than Audi and Tesla's share combined. And for month-to-month sales, BYD in particular has overtaken Tesla in European EV sales for the first time. In April, it sold 7,231 units, compared to Tesla's 7,165 units. Are you starting to see the trend here? China is digging its nails into every single pie. Naturally, such market dominance does not come without consequences for Europe. Companies like Volkswagen, which employs thousands of people in Germany, started losing sales. Factories that made car parts were hit even harder, along with several other European industries. At the current rate, tens of thousands of jobs have been lost, as several manufacturers like Porsche, VW, Audi, and Volvo have announced major cuts. Other industries were feeling the pinch too. Steel from China is so cheap that European steelmakers can't keep up. Places like Italy, where small factories make various machinery, are already closing. In Poland, workers and manufacturing are nervous about their jobs. The numbers tell the whole story. In 2024, China sent $600 billion worth of goods to the EU, making it the biggest source of imports for Europe. But Europe wasn't selling nearly as much back to China. The trade deficit was a shocking $330 billion. This surpasses their $320 billion deficit in 2023, but remains lower than the record $427 billion deficit in 2022. That's a harsh pattern of money flowing out of Europe and into China. This imbalance has finally started to scare European leaders. They worry that if this keeps up, entire industries could collapse as China takes over. The shifting moods haven't just been about money alone. There has been a bigger fear. What happens if Europe gets too dependent on China? China controls 70% of the world's battery production, and most of Europe's electric vehicles rely on Chinese batteries. If China ever cuts off those supplies, say during a trade dispute, Europe's car industry could grind to a halt. The same goes for Chinese equipment Europe needs for its hospitals. This isn't just a random worry. Back during the COVID-19 pandemic, Europe learned just how risky it is to rely on one country for critical supplies. When China faced its own shortages, it held on to things like masks and medicine, leaving Europe in a tough spot. That memory stuck with European leaders, and it's shaping how they think about China today. Many Europeans are wary of partnering with Beijing. According to a recent poll conducted in 11 EU member states by the European Council on Foreign Relations, only an average of just 4% consider China to be a quote-unquote ally. 37% regard it as a rival or an adversary. In countries like France, where protecting local businesses is a big deal, politicians are speaking out. Marine Le Pen, a prominent French politician, has been vocal about blocking Chinese goods to save French jobs. Even moderate leaders, like Germany's chancellor, are admitting that the trade imbalance is a problem. They're saying Europe needs to stand up for its workers and not let China take over. This new shift in attitude is a big change from the days when Europe was excited about Chinese investment. It's setting the stage for tougher policies and a colder relationship. While Europe is grappling with these concerns, the United States is adding more pressure. President Trump is not backing down on China, and in fact, he's turning up the heat. His new trade policy is all about tariffs. He aims to make Chinese products as expensive as he can in the US. Right now, he's imposing a 125% tariff on some Chinese electronics and a 50% tariff on steel. But Trump isn't stopping there. He's offering a deal to other countries, including Europe. The pitch is simple. If you limit Chinese goods in your markets, the US will cut tariffs on your exports. For example, if the EU agrees to restrict Chinese steel, the US might lower rates on European cars or wine. This is a tempting offer, because Europe sends about $570 billion worth of goods to the US every year. Better access to the American market could mean more sales and, again, more jobs. That's exactly what Donald Trump's plan is, to further alienate China on the world stage and leave Beijing stranded. The challenge now is that the EU isn't just one country, it's 27 nations, each with its own priorities. Germany, for instance, is hesitant to pick a fight with China. Its car makers, like BMW and Mercedes, sell 1 in every 3 cars in China. If the EU gets tough on Chinese imports, China might hit back by making it harder for German companies to operate there. In 2024, China was Germany's second biggest export market, worth about €100 billion. Losing that would hurt. However, guess who was number 1? That's right, the US. So Germany also sees merit in the US's proposal. France is also open to siding with the US as it sees China's growing influence as a threat. This is especially true in industries like fashion and food, which are central to France's economy. Smaller EU countries are leaning towards the US. Poland, Lithuania, and the Czech Republic see China not just as an economic rival, but as a geopolitical one. They're already wary of China's ties to Russia, especially since the war in Ukraine. For those nations, aligning with the US makes a lot of sense. It's a way to protect their security and their economies. But getting all 27 EU countries to agree is like herding cats. At trade meetings in Brussels, leaders constantly argue over what to do. Some want to follow the US and impose their own tariffs on China. Others want to keep talking with Beijing to avoid a trade war. The EU's trade commissioner, Valdis Dombrovskis, is trying to find a balance. Trump's tariffs are doing more than just pressuring Europe. They're changing how trade works around the world. Countries like Japan and South Korea are feeling the squeeze too. In April of 2025, South Korea's exports to China fell by 10%, partially because of US tariffs disrupting global supply chains. Chinese car makers like Toyota are reporting slower sales in China as well. This shows how Trump's policies are forcing everyone to rethink their trade relationships. For Europe, the choice is tough. Side with the US and risk angering China, or stay neutral and face higher tariffs from America. Either way, China's position is getting weaker, and Europe is starting to see it as less of a partner and more of a problem. So with the clouds looming, is China sitting idly? Of course not. With Europe slamming the door, Xi Jinping is hitting the roads to find new friends. In April of 2025, he zipped through Vietnam, Malaysia, and Cambodia, inking over 100 deals on trade, politics, and infrastructure. These weren't just handshakes. China's pushing hard to lock in markets for its goods, from electronics to steel, as Europe tightens the screws. In Vietnam, Xi signed railway pacts to speed up trade, while in Cambodia, he backed canals and smart cities to tie them closer to Beijing. Malaysia's got promises of cash for ports and rails, all part of China's plan to replace Europe's huge market. But it's not all smooth sailing. These countries are wary, juggling the US tariffs and China's heavy hand. Xi's charm offensive screams desperation, as Europe's rejection has Beijing scrambling to keep its economy alive. However, new partners might not trust China's big talk after its European flop. And it's not just new markets. China's older plans in Europe, like its Belt and Road Initiative, have also crashed and burned. We'll talk about that in just a minute. As if the tariff pressure wasn't enough on its own, China is also making things worse for itself. Beijing is trying to push back against Western influence, but it's doing so in ways that are backfiring. That brings us to their most recent embarrassment. The CCP tried to pull a sneaky move by using TikTok to mess with Western brands, and ended up making things worse for themselves with Europe.
You know who is producing high-quality accessories for those luxury brands like Chanel, Estee Lauder, L'Oreal? You're saying you're the supplier behind all these beauty accessories for those big luxury brands? La Brea, MAC, Chanel, Bobbi Brown, and even Rosewood Hotel.
Last week we also received an order, Lois Den. Yeah, the comb like 20,000 pieces, one color. It's our painting plate. Here is one of our warehouse. Here is our material area. All the acetate board we have ordered here.
Oh, tell me, what is this? This is like PVC or acrylic?
Acetate material. The material is eco-friendly and more durable and flexible than PVC or acrylic materials.
Okay.
It's the most expensive material.
How expensive?
For this one, for example, this one like 50 RMB one piece.
One piece, 50
Yeah,
RMB.
50 RMB.
And the cost of it.
Yeah.
You see, the CCP saw TikTok as a way to shape what people think. Around early 2025, with trade fights heating up between China and Europe, the CCP decided to use TikTok as a weapon. It went after Western brands like Lululemon and Louis Vuitton, which have a lot of fans in Europe. The idea was to make these brands look bad, like they were using cheap labor or disrespecting cultures. This was aimed at getting European shoppers to ditch them and buy Chinese stuff instead. Pretty shady, right? They paid influencers to post videos slamming these brands, and TikTok's algorithm pushed those videos to millions of viewers. The CCP hid their tracks by funneling money through middlemen, but the whole thing had their fingerprints all over it. And here's where it gets messy. Europe wasn't buying it. First, the European Union, or the EU, was already keeping a close eye on TikTok because of privacy issues. When they caught wind of this campaign, they slapped TikTok with a huge fine for sending user data to China, which broke their privacy laws. Then they started digging into whether TikTok's algorithm was being used to spread Chinese propaganda. This wasn't just a slap on the wrist, it made Europe see China as a threat to its security. The CCP thought they could control the narrative, but instead they gave Europe a reason to crack down even harder. On top of that, European shoppers didn't fall for the TikTok videos. A lot of people saw through the lies, especially when brands like Lululemon said they didn't even use Chinese factories mentioned in the videos. Louis Vuitton also pushed back, saying they weren't involved in anything the videos claimed. People started talking on platforms like X, calling TikTok a tool for Chinese propaganda. Instead of hurting the brands, the campaign made TikTok look untrustworthy, and Europeans started questioning why they were even using it. The CCP's plan to turn shoppers against Western brands flopped, and it actually made people more loyal to those companies. This whole mess didn't just stop at social media, it hit China's wallet as well. Europe was already trying to spend less on Chinese products because of trade issues, and this TikTok stunt gave them even more reason to speed that up. Big European companies started moving their factories to places like Southeast Asia or Eastern Europe, cutting China out of the deal. By trying to hurt Western brands, the CCP ended up hurting their own businesses, which is the last thing that they actually wanted. In the end, this TikTok campaign was a massive misstep for the CCP. They thought they could outsmart Europe, but they just made themselves look like bullies trying to control what people think. It cost them their trust, their money, and their influence. And Europe is now more united than ever in pushing back against China, and this failed stunt only made that push stronger. It's a classic case of a plan blowing up in your face. And for China, it's a lesson they won't forget anytime soon. It's not just failed social media sabotage that's causing trouble, though. China's big plan to win Europe over with its Belt and Road Initiative has also fallen apart, and Italy's story shows why. Back in 2013, China launched its Belt and Road Initiative. This was a flashy plan to spend billions building roads, ports, and railways across Asia, Africa, and Europe. The pitch was simple. China would fund shiny new infrastructure to boost trade, and everyone would win. But for China, it was really about locking countries into its grip, spreading influence, and flooding markets with its goods. Europe, with its wealthy consumers and strategic ports, was a prime target. For a while, it seemed to work, with Chinese cash pouring into places like Greece and Serbia. But Europe's not buying it anymore, and Italy's rejection of the plan shows just how badly China miscalculated. Italy made waves in 2019 when it became the only major Western economy to join China's initiative. Struggling with a weak economy, Italy saw Chinese money as a lifeline. The deal promised upgrades to ports like Genoa and Trieste, turning Italy into a trade hub for Chinese goods. China's President Xi Jinping rolled into Rome, signing papers and talking up big wins. It looked like a coup for Beijing, proof that its plan could charm even skeptical Western nations. But by late 2023, Italy slammed the door shut, pulling out of the deal. Why? Because China's promises turned out to be a trap. The benefits Italy hoped for never arrived. Instead of boosting Italian exports, the deal let Chinese products flood in, hurting local businesses. Italy's trade deficit with China grew. and ports sat waiting for projects that never started. Chinese companies were supposed to build, but the money dried up or got tangled up in red tape. Italians felt duped, like they'd been sold a shiny dream that only helped China. Prime Minister Giorgia Meloni called it a serious mistake, saying Italy got nothing but empty promises. Her government, listening to fed-up voters, walked away to protect Italian jobs and pride. Italy's exit wasn't just about bad deals. It was a wake-up call for Europe. Other countries like Hungary and Portugal also had signed up, hoping for Chinese cash to fix their economies. But they faced the same problems: stalled projects, growing debts, and worries about China's real motives. Hungary's railway to Serbia, backed by Chinese loans, is a money pit, costing way more than planned. Across Europe, leaders started seeing the initiative for what it really was: a way for China to push its goods and gain control, not a partnership. This flop hurts China badly. Losing Italy, a key Western player, makes it harder for Beijing to sell its initiative as a global success. It's a sign Europe's done trusting China's big talk. Instead of gaining influence, China's left with a reputation for overpromising. Italy's move fits right into Europe's bigger plan to shield its markets and stand up to Beijing's economic games. For China, it's another crack in its dream of dominating global trade, and Europe is making it clear they're not playing along. This pushback isn't just about trade or failed projects, though. Europe's also cracking down on China's tech tricks, starting with companies like Huawei. You see, China is also making waves in the tech world, and not in a good way. Chinese tech giants like Huawei and Xiaomi are huge in Europe, with Huawei alone holding a 20% share of the EU's telecom equipment market in 2024. But security concerns are growing. European governments are worried that Chinese tech could be used to spy or disrupt critical systems. These fears aren't new, but they're getting louder. In 2025, Germany and France are reviewing Huawei's role in their 5G networks, which calls to ban the company outright. This comes after reports that Chinese tech firms are sharing data with Beijing, which raises red flags for Europe's privacy laws. China's response to these concerns isn't helping. Instead of addressing their worries, Beijing is doubling down. It's accusing Europe of unfairly targeting its companies and threatening to limit European firms' access to China's market. For example, in early 2025, China hinted at stricter rules for European car makers like Volkswagen. This sucks, as Volkswagen relies on China for 40% of their global sales. This kind of retaliation is making European leaders think twice about trusting China. If Beijing is willing to punish Europe for protecting its own interests, what kind of partner is that? The answer is becoming clear: not one Europe can rely on. Another area where China is really stumbling is in its approach to Europe's green energy goals. China miscalculated a potential market, and it triggered a push in Europe. You see, Europe is all in on fighting climate change, with plans to cut carbon emissions by 55% by 2030. That means building a lot of solar panels, wind turbines, and electric cars. China saw this as a chance to dominate. It already makes 85% of the world's solar panels and 60% of its wind turbine components. In 2024, Chinese companies like Jinko Solar and Longyi sent 10 billion euros worth of solar equipment to Europe. This not-so-little act undercut local producers by 30%. This sounds like a win for China, but it's turning into a problem. Europe doesn't want to swap one dependency, Russian gas, for another, Chinese green tech. And as you might expect, this made the EU's gears turn. In May of 2025, it proposed a 25% tariff on Chinese solar panels and a 20% tariff on wind turbine parts. These taxes are designed to give European companies, like Germany's Siemens Gamesa, a fighting chance. Without them, Europe's green energy industry could collapse before it even gets going. For example, a solar factory in Spain shut down in 2024 because it could not compete with Chinese prices. That meant 300 lost jobs and a step backwards for Europe's climate plans. The EU's tariffs are about more than money. They're about making sure Europe can build its own future without relying on China. And much like all the other cases, China's reaction is making things worse. Instead of negotiating, Beijing is threatening to limit Europe's access to rare earth minerals. These minerals are critical for making batteries and turbines. China controls 90% of the global supply of these minerals, so this is a big threat. In early 2025, China cut exports of rare earths to Europe by 10%, saying it needed them for its own industries. This move backfired. Europe is now investing €2 billion in developing its own mineral supplies. It is developing lithium mines in Portugal and recycling programs in Sweden. It's also striking deals with countries like Canada and Australia to get these minerals elsewhere. China's strong-arm tactics are pushing Europe to find other partners, and that's a trend Beijing can't afford. Beyond all this, Europe is tightening rules on Chinese investments. Chinese companies used to buy up European businesses, from ports to tech firms, with little pushback. Not anymore. In 2025, the EU strengthened its investment screening process, which checks whether foreign buyers pose a security risk. This has already stopped several Chinese deals. For example, the German government stopped Elmos, a Dortmund-based chip maker, from selling its production facility to a Chinese company. Officials argued that the acquisition would endanger public order and security in Germany. Another block deal involved ERS Electronic, a Bavarian semiconductor company specializing in thermal wafer testing. The German government did not disclose details, but confirmed that a second Chinese acquisition was halted. The message is clear. Europe isn't letting China take over its critical industries. Another big step is closer ties with the US. Trump's tariff deal, where countries get lower US tariffs if they restrict Chinese goods, is gaining traction. In April of 2025, the EU and the US started talks on new trade agreements focused on reducing dependency on China. This includes joint projects on semiconductors, where China controls 60% of the supply chain. By working together, the US and the EU hope to build their own supply chains and keep China out. For Europe, this is a way to balance its trade relationships without being pulled too far into Trump's orbit. It's a pragmatic move, but it's bad news for Beijing. These changes are reshaping China's place in the world. With Europe pulling back, China is losing access to a market that buys $600 billion of its goods every year. And this isn't just a numbers game. It's a geopolitical shift. China's economy is already slowing, with growth at 4.5% in 2024, below historical averages. Losing Europe's trust makes it harder for China to keep its factories running and its people employed. Meanwhile, Europe is finding new partners like India and Southeast Asia to fill the gap. India, for example, signed a trade deal with the EU in 2025, promising to supply electronics and textiles at a competitive price. This shows Europe is moving on. And China, they're being left behind. The stakes are high for China, and it's not just about trade. Beijing's global influence depends on being seen as a reliable partner. But with Europe turning away, that image is crumbling. Other countries are watching, and they're starting to rethink their own ties with China. Australia, for instance, is pushing back on Chinese investments, citing the same security concerns as Europe. Even in Africa, where China has spent billions on infrastructure, some nations are questioning whether the debt is worth it. China's dream of leading the global economy is slipping, and Europe's rejection is a big reason why. So, where does this leave us? Europe's turn against China is a story of high hopes gone wrong. It started with China's big plans to win over the EU, back when both sides saw a chance to make money together. But China's flood of cheap goods, its cultural missteps, and its aggressive tactics changed the mood. Europe, worried about its jobs, its industries, and its security, is now pushing back. Tariffs, investment rules, and new alliances with the US are all part of this shift. For China, the consequences are real. A weaker economy, fewer friends, and a tougher road ahead. This isn't just about Europe and China. It's about the world. Trade is how countries connect. And when a major player like the EU changes course, everyone feels it. China's mistakes are costing it dearly, and Europe's response is setting a new tone for global trade. The days of easy deals and open markets are fading, replaced by caution and competition. For Beijing, the lesson is clear. You can't bully your way to the top. Europe is standing its ground, and China is learning that the hard way.